Welcome out to the BluSky Trading Lab, ladies and gentlemen. This is Coach Matt. We're going to be talking about news-based trade ideas, how to identify them, and specifically how to prepare for them, how to get to the point where we feel, my mouse is being sensitive there, and we feel comfortable with processing the trades after the fact. Now, I got a question for everybody. How many of you are familiar with trading news-based events? That's right, Crayon Hours, Pete. Who here is familiar with how to trade news-based events? Just yes or no. Just give me a general yes or no. Okay, good. And Cindy, isn't that why we're here? So that we increase our financial IQ and our trading arsenal every week, right? To work on our skill set every single week. That's why we're here. So, what I want to do, guys, is I want to have a conversation on news-based events from the very beginning. What are they? How to identify them? How to determine the major ones that have the ability to really move the market? And then how to process the information after the fact so that you can really get into the right mindset regarding how to process the trade afterwards. Now, before I get into that, guys, when I was a young trader, 20 years ago, and I was first starting to learn how to trade, I loved news-based trades. I loved news-based trades. And they were very simple to process. They were extremely simple to process. And what I mean by that, guys, is 15, 20 years ago, there, there's this concept in the market called priced in. How many of you have ever heard of that before? And I know many of you have, but how many of you have heard of the concept of priced in? Who here has heard of that before? Okay, Gabber, you have. Who else? Just heard of the concept of priced in. Okay, yeah, I would think most have, right? Now, right now, when you think about that conversation today, the PPI report came out today, earlier today. It's a major economic report. It's one of the biggest reports this week. In fact, I would say it's the second or third biggest report this week. Now, has that report, as of right this very second, has that been priced into the market? What do you guys think? Came out earlier today. Is it now priced into the market? I would say yes. I would say yes. That's what I would say. The market does not take long in the age of 2025 to price something into the marketplace. It's very quick. You see the initial reaction down, and then you see a kind of meander into some degree of neutrality for the most part of the day. That's because the PPI report really didn't move the needle from the macro conversation perspective. You saw the headline number get priced in, and then the secondary analysis was like, oh, whoa, 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 whoa. The PPI report, for example, came in at zero point 0.9. It was a massive headline miss. It was a massive headline risk. It had a massive move to the downside, but then nothing else happened. It had this initial reaction to the downside, and then it was right back up like nothing transpired because the initial reaction, the initial movement, it gets priced in. And then the reason we didn't get any follow through, guys, was because the time it took us to actually go read the report. How many of you guys actually read the PPI report today? Did anybody here actually read it? Our, that's a good question. I did. I did. Okay. I did. Now, that's a little bit of a lie. I copy pasted it, put it into my chat GPT and told me to give me all the data. So that's what I did. Okay. So I just got I just wanted to familiarize myself with not just the headline number, but is there other reasons to be concerned here? And you know what? The biggest impact of the PPI report that had that big, massive headline risk, it was on Wall Street management fees. Wall Street management fees were up like 5.6% month over month. It was the biggest impact, had like a 10% impact on the entire PPI report itself. Outside of that, you had manufacturing services were up like 3.6%. You had some other services that were up around 2%. But if you discount those three things, you were pretty much in line. And when the market gets the context for that report, it's like, okay, not as bad as the initial headline. And if the initial headline priced in the headline, well, what's the market going to do the rest of the day? It's going to be in a recovery mode because the detail of the report was not as bad as the headline risk. And so we saw that happen today. But the actual number that gets priced in very quickly, very quickly. Now, who here was trading 10 years ago, 15 years ago, 20 years ago? Was there anybody here trading back then? And I'm willing to bet not a lot. Okay. Tipped you. Tipped you. You've been around for a while. Yeah, I was trading 20 years ago. This is legitimately my 20th year. I started in 2005, October of 2005. So yeah, about 20 years for me, Tipped. Um, Tipped, do you remember back in the day when you first started trading and we would get these major economic reports? And they weren't just conversations over an intraday read. It would have a conversation that would last from today till tomorrow. You know, if it was a labor report, man, the market would be sensitive even that next Monday, right? Those major economic reports, they took time to price in. See, what we all know is that the market over the course of as technology has advanced, as algorithms now really drive price action, and you're right, Gabber, a lot of people had to wait for that bar chart. Now that might have been the 90s, but you are right on that. The point is, this pricing in event is important to understand because it goes to help us understand secondary impacts of economic reports. And so the conversation of priced in simply means when new news comes into the market will price that news in. And as everybody else has conversations next week and the week after, well, the market's already moved on. The market gets so much data on a day in, day out basis that it doesn't linger into the market. The market will price it in and then it will move on. 40 years ago, that pricing event would be multiple weeks. Multiple weeks. It would take that much time for all the news to get around to have the totality of the pricing power to impact the market. It would take days to weeks. 20 years ago, it would take hours to days. Today, it takes minutes to hours, depending on the size of the report, the importance of the report, the context of the report. But we're talking very, very, very quick timeframes at this point. And so when you hear traders talked about that data is priced in, they're simply saying the economic report has already occurred, the market has already responded to that event, and now we're moving on. Now it's time to have a different conversation. And when it comes to those ultra intraday timeframes of those secondary patterns that we love to trade, well, guess what? A lot of times those things happen within 30 to 60 minutes after the release of the report. See, I'm not one that says we should get in front of an economic report. The same way I'm not one to recommend that anybody stands in front of a freight train. I don't think that's very, very successful lifestyle. I don't like your probability of successfully doing whatever you're trying to do when you stand in front of a freight train, the same way I don't feel like you have a very good edge if you're in front of the algorithms. And see, you never know how those algorithms are going to respond. You don't know the data that's going to come out. You don't know how the algorithms are going to respond. And so it's really not a matter of trying to get in front of a report. It's really trying to understand those secondary impacts that happen after the algorithm smooth out. So a lot of how I feel about news-based trading is about the preparation we do in front of the report to understand the impact of the report, to understand the timing of when I should be paying attention. But it's really about what happens after the report itself. It's really about what happens as volatility declines and you see where the true edge is in the marketplace. Now, on a day in, day out basis, like I said, guys, we get a ton of reports into the market. And a lot of the reports that do come into the market are what I would describe as intermediate, minor, very, very, very low impact type reports. When you actually think about all the different economic reports that have the ability to really kind of impact the market, Forex Factory is in my estimation the best economic calendar website out there. I know there's some other economic calendars out there, but I use Forex Factory. It's I've been using it for a very long time, and I just like the cleanliness of their calendar, quite frankly. I like how it just lists out, you can come up here to the top right hand side right here, and you can tell, okay, which ones do I want to see? Do I want to see all the economic impacts, all the different impacts? Do I want to see all the different event types? What types of economic reports do I want to see? As a currency trader that trades on the overnight action, I like to look at the European economic reports. I like to look at the British economic reports. I don't usually look at the Japanese economic reports because they don't really have an impact on much of anything unless it's out of their central bank or their bond market. But I like to look at these reports out there. But as for our purposes here, let's just look at the US dollar reports. If you're just trading futures in the United States, if you're just trading equities in the United States, looking at the US based reports are perfectly fine. Now, on your expected impacts, you really don't want to see any minor economic reports. When we're talking about news-based trading, we're talking about events that have the ability to drive the marketplace, not just have a singular impact on some space, some industry, some sector, but we're talking about those big-time reports. How many of you guys have ever seen the movie Trading Places? Have you seen the movie Trading Places? That wonderful, funny movie with Eddie Murphy back in like 1983, 1982. Do you guys remember the report that they were trading? Oh, that's hilarious, Tipped. Does anybody remember what report it was? I want to see. No Googling either. MJ, if I was trading on the overnight session, yes, I would want to see the European reports. The RQ, the report in Trading Places that they were trading, that the entire movie is centered around. It was the crops report, right? It was the crops report. And everything for a week was centered on this report. That's how important those reports were back in the day, right? They had a big time impact. They had a lasting impact. Well, we want to see those types of reports, those big time economic reports. And so you just want to look at the red colored ones here, hit that apply filter, and what you'll see is a list of just the major economic reports. Now, about a week before these reports happen, okay, you're going to start to get the forecasting of the reports. And so, like, for example, next week here, we got the FOMC minutes. There's not going to be a forecast there. But on like manufacturing PMI, services PMI for next week, we're going to start getting their forecast here in a couple days. And that's what everything in the world gets based off of. It does not get based on what happened last month. We know the score last month. We know it's already priced into the market last month. And this month, the last month will be important for like those swing traders and those investors and people that are making decisions longer term. But when it comes to news-based trading, this number on the previous number really doesn't have anything to do with it. Everything is based around the expectation. And so, for example, this week, when you're looking at that, what's everything based around? Everything's based around this expectation at 2.8. For example, on the CPI release, if you look at the actual numbers, everything basically came in line on the CPI day. But the CPI report saw a big move in the market this week, had a big momentum move in the market, especially in those cyclical areas of the market. Why? It wasn't because the month over month came in line. It wasn't because the 2.7 that we got last month was equal to this month. It's simply because of one thing, ladies and gentlemen. And that one thing is a random economist polled had an expectation of 2.8, which means everybody judges the CPI event not based on last month, but based on the expectation that was supposed to come into this month. And because it came in as a miss, what was the initial reaction by the market? The initial reaction by the market was up, 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 up. You come over here, for example, to the Russell 2000 on that move that we saw on Tuesday here. And what was the initial reaction? Here's the CPI event right here, this big old candle right here. Here's the CPI report. That initial reaction skyrocketed. Now, let me ask you a question, guys. On this 1 minute time frame, okay, I'm just looking at this 1 minute time frame. This pricing all happened in seconds, in absolute seconds. When the data was released to the market, it took 1 second to price in that headline miss. 1 second. Did anybody in that time frame, did they have the ability to actually go read the context of the report? Did they have the ability to go understand if the CPI report was an issue, if it was a problem, if there was something else wrong with it, or was it simple an algorithm move? That's all it was. It was just an algorithm move. Those algorithms price it in, and then it becomes a secondary story. See, the markets don't wait on things. Not at all. The market will price that in immediately and then move on. When you saw, for example, today, the PPI headline miss, and it was a shocking miss, guys. Expectation was zero point 0.2. We came in at zero point 0.9 here today. Core came in at zero point 0.9. This, guys, we haven't seen these types of misses on the PPI report since pandemic. And so when everybody saw that headline, you know what they thought? Pandemic, inflation. Well, I think somebody at the BLS probably thought I'm getting fired. I guarantee that labor report in a couple weeks is going to be a big time number. Like we're going to all of a sudden, RQ, we're going to have like 2.3% unemployment report. And everybody's going to be like, wow, look at that. Let's price that bad boy in. But you saw that big time headline miss here, just concern everywhere. Well, what was the initial reaction on the PPI report? Let's go look at the ES here. Let's go look at the 1 minute chart here. All right, sizable move to the downside, continuation to the downside, and then it settles in. And so this shocking headline number, how long did it actually have an impact on the stock market today? Before the market just started doing the same things it always does. How long did it take? Like in totality? 30 minutes maybe? Yeah, I'd say that. 30 minutes maybe. Two decades ago, 20 years ago, we'd be talking about that PPI report tomorrow. I guarantee it. The market would still be pricing that thing in tomorrow. And that's something you have to keep in mind, that these algorithms, especially as AI starts coming online, do you think these things are going to happen faster in the future? Or do you think these things are going to happen slower in the future? It's definitely going to be faster. It's definitely going to be faster, guys. There's no doubt about that. Algorithms dominate. Now, how much faster can you get? I'm not sure. Like the pace of that is going to slow, but it's certainly going to get faster. Nectarines, Coach, don't you think we're in extremely bubbly bullish conditions? No, I don't think we're in bubbly conditions. Um, but I think there's certain areas of the market that are. Does that make sense, Nectarines? Like, I would not describe the Russell 2000 as bubbly, for example. I wouldn't describe the Dow Jones, which has not broken out of a major level of resistance in 9 months, as bubbly. For example, the Dow Jones here is at the exact same high that it was 9 months ago. Earnings in that time frame have went up, 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 and up. We've had three fantastic earnings seasons in that time frame, and we're still at the exact same price point. And so I wouldn't describe the Dow Jones, the Russell 2000 as bubbly. I wouldn't describe healthcare as bubbly. I would describe, maybe some hyperscalers, as that. But when you also talk about bubbly, it's far more than just a technical conversation as well. It's a fundamental valuation conversation. And right now, the forward PE ratio of the S&P 500 is about 21. The average 5 years is around 18. And so I would say we're elevated fundamentally. We're elevated from a valuation perspective, but I wouldn't consider it bubbly. No, no. When you're talking about bubbles, guys, like we have a lot of, not we here, but a lot of people have a tendency to describe a lot of things as bubbles. Bubbles are a valuation conversation. Like if price is going up, but EPS is going up to match price, that's just another day that ends in Y. If EPS is trending up and the market is trending up, that's a really good case for the market continuation. Now, Palantir with the 14 billion PE ratio that is on a freight train to 200 that never wants to slow down because of the growth narrative of them taking over the world from an AI perspective. Yeah, that's a different case study. Can we see bubbles in individual stocks? Of course we can. Of course we can. In even the most benign market conditions, you will see certain stocks take on bubble-like mentality. But let's not make the mistake of assuming individual components like Palantir are the equivalent of the entire stock market, which when you're looking at the entire stock market, here's the equal weighted ETF known as the S&P 500. I would not describe that technical condition as bubble. Oh, no, no, no. It's a great question. And I love questions, Nectarine. Do not apologize for that question. As an educator, no, you can't derail me. If I find it to be an interesting question, I'm going to take some time to answer that interesting question and get right back into the conversation. I love participation. I love questions. I love communication. And so never apologize for that, brother. Never, ever, ever. I thought it was a good question. I thought it needed to have a detailed answer. And so, yeah, we'll get back into the conversation, brother. But just don't apologize for that. I like the question. All right, let's get back into it. Now, the question ultimately, after we understand kind of pricing and whatnot, is which one of these reports are the reports that are what we would consider the major economic reports? Because once again, we get a tremendous amount of different types of economic reports. Now, the first thing, guys, is realize this. Not even every major report that they color red is a major economic report. I see a lot of times they will color code a report red, and people will assume that means just end all be all type report. A lot of times I'm just like, that's not a major report. The types of major reports that we look at are the ones that really have the ability to drive the conversation, to have the ability to change the conversation in the market. Things like anything that has anything to do with the Fed, that is 1A, 1B, 1C, which means the Fed, inflation, labor. That's the tippity top nature of the economic reporting system. Everything else is secondary to those three. Once again, it goes Fed, inflation, labor. And so the Fed obviously is the Fed monetary policy statement, the Fed meeting minutes, the beige book, but it's really the Fed, not the minutes that we get, and not really the beige book, it's the Fed policy statement. Inflation and labor are 1A, 1B. Those are always going to be very important to the market. Which ones are more important to the market? It typically depends on which one is impacting the Fed. And up until now, that's been inflation. Now that's most likely labor. Now that's most likely the labor side. Um, I personally, RQ, feel that I have some concerns on the inflationary side of the equation. I have more concerns on the labor side of the equation. I feel there's some real damage happening on the labor side. And as such, I think it's important for the Fed to get in front of the labor because if labor gets and macro conversation that I think is happening in the backdrop is AI is starting to have an impact on the labor side as well. And I think AI is going to increase its velocity of its impact on the labor side as we work into 26, as we work into 27. And so I feel like labor is going to be a very important part of this equation. And so I do see it kind of balanced right now, and I don't, but I do see as we move into the future, labor is going to become a little bit more important part of that, more important part of the equation. And we're starting to see the impact now. And so I would say typically inflation down, labor up. That's the slight economic drift that kind of fixes inflation because inflation would go up in the short term, labor would go down in the short term, but as labor goes down, the economy goes down, consumers start spending less. That fixes the inflationary side of the equation. And so if your concern is on the labor side, you obviously expect a little bit of economic weakness, and that should have an impact on the inflationary side. And so it's a complicated balancing act right now. But right now, I do think the wage I do think labor becomes more important moving into the future. But again, we're talking 1A, 1B. Both the CPI report and the jobs report the first Friday of the month, CPI report the second Tuesday of the month, typically sometimes the third, but both of those are going to be equally important. And then you start getting into the secondary impacts on major US reports, and that would be anything with the GDP, just the first report in the GDP series, retail sales, which we get tomorrow. That's a fairly sizable, important report. And so we get three really interesting reports this week. We got CPI, PPI today, and then we get retail sales, consumer confidence, manufacturing data such as PMI numbers on both the manufacturing side and the services side would be secondary reports as well. Now, when you're looking at the calendar, before we get into the process here, so the three reports this week that I think are a little bit more important than others, the CPI, PPI, retail sales. When you're looking at next week, I really don't see anything next week that is a major report. You could argue flash manufacturing is, but not in front of Jackson Hole, which is the massively important symposium that happens at the central bank level. Meeting minutes, that could be a driver next week. Obviously, it's a secondary report that comes out of the Fed, but that certainly could be a driver next week, especially as we're trying to, figure out exactly what the Fed's going to be doing with policy. But usually I would say manufacturing is a little bit more of an important report here, especially as we came into contraction territory last month. But I just can't say that given the fact that Jackson Hole's literally the next day, and Jackson Hole is kind of an end all be all Fed event. The week after, PCE price index is the fourth most important report in a series of economic reports. My point is, guys, we only get two or three major economic reports each week. It's not like we get inundated with major reports that have the ability to drive the price action the way that has happened this week. This week we had three major reports. Next week we have maybe one major report. The week after, maybe one major report. They don't happen as much as you would expect when you think about the economy and its impact on the price action. Now, one thing that I think that we can all agree with is when you're going into a news-based event and these reports are going to be reported, we know what's going to happen. We know the algos are going to price the new data in. Can we all agree with that? That we know that the algos are going to immediately price in the event. And we know that's going to be extremely sensitive on price. And if we know those things, do we have an edge going into the report? That's the question. Do you have an edge, or are you RQ the edgeless? Which one are you? Do you have an edge, or are you edgeless going into the report? Like we had the labor report here. Do you have an edge in front of the report? I'll give you a second to think about it. It's a dull edge. RQ says it's a dull edge. How many of you agree with RQ? It's a dull edge. You have no edge going into the report. And if you have no edge going into the report, should you be making a trade in front of the report? The answer is no. You have no edge. You have no clue how the market is going to impact. You don't know the number. You don't know the market impact. You don't know anything yet. So, if we shouldn't be making aggressive decisions in front of the event, and we know there's going to be a lot of volatility immediately following the event, what do we do? What is that? What is the process we traders need to go through to ensure that we're making a trade with an edge? Yes, I would agree with that, Nectarines. I would agree with that. Now, like I said, a couple decades ago, guys, even 10 years ago, I would say, even 7 years ago, I would say, I just wouldn't say this after the pandemic. There were some things that changed after the pandemic. The market started behaving far more algorithm driven. We started seeing far more V-shaped recoveries more than traditional reversal recoveries in the market. There was even fundamental differences post-pandemic versus pre-pandemic. My help, post-pandemic, guys, we talk about companies like Amazon and Apple and Nvidia and Google and these Mag 7 hyperscalers, which 10, 15 years ago would only be seen through the aggressive lens. People now talk about them legitimately as safe havens because of their large moats and their extremely large cash positions that allow them to withstand anything negative economically. That wasn't the case 10 years ago. That certainly wasn't the case 20 years ago. So things have changed after the pandemic. Before the pandemic, trading news-based events could be really, really fun in front of the event because you didn't deal with that sizable volatility. And that sizable volatility, guys, is very important because if you put on a trade to get to trade in the volatility, to get into the trade when the volatility begins, or if you get into a trade in front of the volatility and you have a stop loss that you think is in a really good position, all of those things are fantastic until volatility hits. And then when volatility hits price, guys, it's not just price that's volatile. It's bid-ask spreads. Bid-ask spreads widen. Stop loss hunting begins. Like it becomes a real difficult situation in today's market to be aggressive in front of a news-based event, in my estimation. But 10, 15 years ago, guys, I'd be very aggressive here. I would identify step one. I would identify my levels. Okay. So when I was getting ready to trade a news-based event, I would identify my levels on a 15-minute chart. What were the major resistance zone? What was the major support zone on that intraday time frame of my choice that I wanted to trigger above on a breakout or below on a breakdown? And if the market, and then step two, I would place my orders, put a buy stop above resistance, a sell stop underneath support. And you know what? Guess what? If we triggered above because we got that massive algorithm move, oh my goodness, giddy up and go, 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 go. And if it triggered down, oh yes, giddy up and go, go, go. The problem with that today is the bid-ask spread's going to widen, volatility is going to smoke, execution is going to be, you're not going to get filled in the right time frame, and you might think, well, it might just take a couple seconds. A couple seconds, it's a massive difference. Is a massive difference. Just a couple seconds in a news-based event is a massive difference. And so you can't do that any longer, in my estimation. You have to be a little bit patient here. And this is something I talk about quite a bit quite a bit in both the stream with Riz and Mike, but also here in this lab, is preaching patience in pattern development. If you are always patient in pattern development and you call out your pattern and you're willing to hit it after you get that, you're going to be a successful trader for a very, very long time. So, my recommendation is you don't fight the algos. You allow the algos to do the initial pricing events. You allow that volatility to settle in. And how do you know volatility settles in? Well, there's a couple different techniques. You can look at the volatility indexes. You can look at the candlestick width. I just simply like to look at the candles. And if the candles start getting a little bit narrower, guess what? You're priced in. And so you could wait for ATRs to decrease. You could wait for candles to get smaller. You could wait for support and resistance to start holding. You could wait for your patterns to develop at those key levels of support and resistance. You can look at the volatility index to watch volatility come down immediately following the event. There's a lot of different ways you can wait on volatility declining. But think about it like this, guys. When you see a dam break and the flooding ensues, because that's what volatility is. It's the dam breaks, volatility ensues, water ensues, flooding happens. Do you know the real damage until the water resides? In a flooding situation, does anybody know the actual damage until they can see the visuals of the flooding residing? You can't make any assumptions on that. Same thing here happens, guys. When the dam breaks in the market and volatility pours out into the market, you don't know the damage. You don't know if it's good, if it's bad, if it's indifferent until that volatility resides. You didn't know the initial reaction to the PPI report was nonsense today until the volatility resided. And then when the volatility resided, guess what? A bottoming formation happened, good reversals started happening, trends on lower time frames started happening. That did not happen in the ES. I'm more talking about the RTY today, and I'll take a look at that here in a second. But the point is, it doesn't take long, 15 to 30 minutes typically, for that volatility to come out of the market. And so instead of being so aggressive in front of the event, we prepare for what we're going to do after the event. And so now for me, my step one in trading news-based events is I identify the economic report. Obviously, coming into this week, there were three of them. You had CPI on Tuesday, you had PPI on Thursday, and you have the retail sales on Friday. Those are the three key events that I identified coming into this week that I was going to be news-based trading around. And so the first step is we identify those economic reports. The second step is I want to identify my levels. What are the levels I want to track? And the reason I want to do that is so that I can prepare myself for where the volatility can subside, where can I start to really get into pattern development mode. And so I want to identify my levels. Step three is to wait on the release of the event. We see the initial drive up or the initial drive down, and we wait on that secondary pattern to develop. And so, for example, markets just meandering between support and resistance. And let's say an economic report comes up, and all of a sudden we see this explosive volatility to the upside. Okay, and you see all this volatility. Well, the secondary pattern will not occur until that volatility starts to decline and the ranges get a little bit tighter and it comes into key levels. And so it's a story being told on that key economic report. And so you got to prepare with your levels, but at the end of the day, you got to be ready to rock and roll when you get your pattern. Now, what I want to do is I want to go into the market. I want to look at the CPI report from this week. And I want to talk about how we could have processed that report, where the appropriate triggers would have been according to me. okay, according to us in this stream right now. Now, we're looking at the 15-minute chart. This is the Tuesday CPI report right here. Now, if you'll see the CPI report on we're looking at a 15-minute time frame, and I like to look at 15-minute time frames, guys, going into the report. Sometimes 30, sometimes 15. But what I'm trying to do is I'm just trying to understand the ranges and the important levels going into the actual report itself. Okay. Can everybody see the chart? Can everybody see the stream? Are we still good? I should have toss up. Do you see Thinkorswim? You see the chart? Okay. Tizo, just log out, log back in, should fix it, buddy. Yeah. So what I want to do is basically before the event, I want to identify the key levels here. And the reason I want to identify the key levels is because I want to make sure that I'm ready to understand where I need to be prepared to make decisions. Now, I'm willing to make decisions in pattern development that is fresh, but a lot of times these things happen at key levels. And by next week, guys, I'm going to do the entire lab on simply defining all the different levels we talk about in the stream with Mike. And so if you're ever sitting in the stream with Mike and he's talking about bank levels, Fibonacci levels, this level, that level, I'm going to just do a simple definitional series defining all the levels so that every single one of us know exactly what everybody's talking about so that we are ready to rock and roll because you know what? When Mike says something, I just want to take some action, right? I just want to take some action. I trust Mike's eye. I trust his read. And as long as I understand his read, I just want to take action. And how many of you are just like me there? By the way, when you're watching Mike do what he does, you trust Mike. You know he's got this a great read. He's an amazing trader. He's been doing it for years. I just want to understand everything he's talking about so I can do the same stuff, right? How many of you agree with that, by the way? Oh, Mike is money. Man, Prince money. The Mike is the central bank. Like that's what Mike is. He's the central bank of traders. That's what he is. And so I'm just going to do a definitional series on understanding key levels so that as we have these conversations, we'll have those and we can always refer to that. So I'm going to do that next week. For this week, the levels that I like to look at is key technical levels. And so going into the CPI report, I felt this level right here, the 6410, was a massively important level. I just felt this was going to be a level. It had double bottom situations before the breakdown. It retested those levels at 6410 going into the resistance test in front of the report. And so 6410 was certainly a number. The level on the downside that I was looking at was this level right here at 6392. Once again, I'm not looking for a one test against resistance or support, guys. I'm looking for major levels. Major levels get tested over time. One pivot point is not a strong pivot point. One pivot point that gets confirmed, that gets battle tested, that's a structure where you could see a really legitimate breakout type situation. And so those were the two levels of immediate importance going into the CPI report. Now, secondarily, if you saw a move to the top side, I felt like this double triple top up here around the 6430 was going to play a role. It didn't really. It didn't really play a role initially, but that was the level I was looking at as well. Now, after you identified your levels, guys, you're waiting on certain things to occur. Now, I think we can all agree that the absolute best entry was people who bought the wick low against the 6410 level right here. That's really tough to do, honestly. It is. It's tough to do. In fact, the volatility really hadn't declined yet. You're still seeing a lot of price movement. The event happened an hour before the market. Then you had the cash open here that kind of increased volatility. And so remember, one thing that I think is important is not just to understand your levels, but to understand when volatility starts to decline. It's not just a pure pattern conversation. Don't get me wrong. If you bought the 64.10 bounce, that is a beautiful buy the dip situation. I'm talking a structured technical trade, guys. I'm not talking the degenerate gamblers who are just trying to pick up price at a certain level without an edge. I'm talking about trading with that edge. And so, in my estimation here, the best trade setup, honestly, following the CPI report, was after the cash open, after well, we're educated guessers here, RQ. My comment was really towards the degenerates on Twitter who act like know it alls and don't trade with any structure and just talk about their winners on Twitter. I guess I saw that 3 times today on X. Sorry, it's not Twitter anymore, X. I was like, okay, that's who I was talking about. I believe me, that's not us here. Us here, when we speculate, we do it with an educated guess. Absolutely, 100%. But what I'm talking about, guys, is allowing the volatility to decline so you know the market is priced in so you don't have to deal with unexpected volatility. And I don't see that happening until right here. Do you see how big up, big down, big up, big down, but then it starts to settle in right here? Once it starts to settle in, you start to finally see the structure of pattern development here. You start to see it happen at a key level, 64.30, consolidation right as the 9 EMA catches up. Now, that's where the volatility started settling. That's not where I made my first trade. I made my first trade right here as it broke out of the multiple time frame of resistance. And so when you're thinking about this CPI report event from this week, you had the event release here at 8:30 Eastern Standard Time. You had the cash open right here at 9:30 Eastern Standard Time, an hour after the CPI report. You had the volatility decline about an hour after that at around 10:30 Eastern Standard Time. And then you had the breakout at 11 o'clock Eastern Standard Time, a whopping 2.5 hours after the release of the event. And so to me, the best trade was waiting for that to settle in. And that's how I feel about trading all of these events. And yes, would have been much better for me just to get a little bit of an aggressive trigger at 64.10. Yeah. And would have worked out spectacularly. It would have worked out. But guys, you don't have an edge there. You have a support bounce, but you don't have an edge. This thing could have easily got you rocked to the downside. Absolutely rocked to the downside. You have lots of volatility here still. You start settling in here. You start to see the consolidation set. And then when you saw that breakout here, guys, look at the consistency of the price action following that breakout. Finally, after the volatility subsides, you get that breakout right here. What happens? A smooth ride of consistency up to the top side before it gets a little bit of a double top. And so on the CPI report, the initial pricing in took about 30 minutes. The totality of the volatility took about an hour and a half after before it gave a beautiful trade signal to the top side when it was breaking out of resistance. So when I'm talking about trading news-based events, guys, it's understanding the complete backdrop of how these events get priced into the market. And because there was a lot of sensitivity around the CPI report, the volatility took a little bit more time. But does that help you understand how to navigate these big time events, ladies and gentlemen? Does that help? Awesome. You guys having fun so far? You guys learning? That's our two goals. Every session, guys, we have two goals. Number one is to have some fun, while number two, we learn a ton. I think I just rhymed. I did. Even that was fun. Okay. Now let's look at the PPI report and let's look at it through a very similar lens. Now, the ES, I didn't trade the ES today. I traded the Russell 2000 today. On the ES, obviously, we can all see where the event transpired, right? You had this big sizable move to the downside. It broke through every level that you were looking at. The previous day had some consolidation. So it broke through every level. Now, what's the second step after the release of the information? What are we waiting on? What's the number one thing we want to wait on a little bit? As the event increases volatility, we want to watch volatility decline. And through that process of volatility declining, you can start identifying pattern development. That's where you start to see patterns. To me, and I don't know if anybody took this trade, this is a pretty good trigger right here. Consolidation wipes off the stink of the volatility. You break through that consolidation. Once you break through that consolidation and close, you got an edge on the ultimate short term. Now, I was looking at that in the moment, and I didn't love it. I saw the trigger, but I didn't love it. And the reason I didn't love it, guys, is because when you were looking at like the longer term time frames here, you saw that down to the downside, kind of flip back up here. I was like, do I really just want to trade inside range here? Like, yeah, I think it's going to recover here, but no, where do I want to go? And so I went over and I looked at the Russell 2000 here. And basically what I said was I kind of felt like we were getting a little bit of a bottoming action on the ES. And I was like, all right, if you look at the last 2 days here, guys, big time momentum over the last couple trading sessions. Today's volatility really only brought the market down in between a 38 and a 50% pullback level, which is, pretty standard Fibonacci type move. And so I was like, all right, if we're going to pull back 38 to 50% of the pullback, I'm going to look at the Russell 2000 here. And when you're looking at this volatility here, the initial movement was to the downside. It continued to fade to the downside. I was not shorting this at all. I was waiting on pattern development because I kind of felt like we were going to see some slowing momentum. And we got our left shoulder. Actually, I was doing it on a 5-minute chart. So let me show you on a 5-minute chart. So right here, after it broke down right here, I was prepared on the Russell 2000 above that level. I wasn't going to short it. I was prepared to buy it. But as it broke support here, it didn't go down much. That put in a little bit of a base. That put in the head. That put in the right shoulder. And that was a beautiful breakout right there. I wish that we still had another hour left in the session, but was that breakout. My first trade was kind of like a partial here. My second trade, I added on the breakout there. And I closed right at 209. I got stopped out about right there. So I made 2 trades today on the Russell, added to it. It took me a little bit of time, but was that time well spent? On here, on the left shoulder, yeah, I wasn't looking to make the bull trade here, RQ. It was here where I was like, oh, that's not a real breakdown. It was here that I was like, no, that tried, it failed. I didn't feel like, I feel like this momentum was shifting here and the ES was already starting to climb. And the reason I was looking at the Russell 2000 the whole time was, and I didn't get it, by the way, but this is the reason I was looking at it. If we were going to get a sizable recovery today, I felt like the Russell just had more steam in it, more gain in it, more return in it. Like that's the reason I chose the Russell 2000. But I didn't process my trade until it got back up above my pivot point, and it was an extremely partial position, like partial. The real trade is right here on this candle, right there. This candle, when it breaks out of that resistance level, this was what I would consider the neckline in the head and shoulders formation. And so that's where I made that trade. But when you come back to the news based event, guys, either on the ES, the NQ, or the RTY, it took a little bit of time before that trade became a legitimately really good trade. But it was worth it. All right. With that said, did you guys learn how to navigate news-based trades a little bit better today? Awesome. Awesome. All right. If you have any questions, put them in. MJ, how do you say which market to trade? Honestly, most of the time for me, it's ES, MJ. It's kind of my baby is the ES, but I just felt like the Russell 2000 today, and I really don't trade the Russell 2000 a lot. Like I just felt like today when I was doing my intraday analysis and I was doing my cross check against indexes, which I do every day, I just felt like if the markets were going to recover, that algo move to the downside on the Russell 2000. I just felt like if it was going to recover, like I kind of liked the overall zone that it was developing in, like this old pivot point on the breakout. And so I just kind of felt like that had a good position. I didn't mind the position on the daily chart it was at. So it was more just a situation where the Russell got popped a little bit harder today. And because it got popped a little bit harder on any recovery, I felt like the Russell, which had the leadership position on all things the last 3 days, it outperformed on the top side the previous 2 days. It outperformed on the downside today. And so I just kind of felt like if there was going to be a recovery, and the Russell was more sensitive over the last three trading session, it was going to continue to do so. It worked out about equally to what the ES did. So my analysis didn't pay out that way, but I would do it again tomorrow. I would make the exact same decision tomorrow. I check for as a day trader or in general, MJ, because my answer will be different. In general, I check all four indexes every day on multiple time frames. So Russell, Dow, Nasdaq, S&P. Day trading usually NQ and NES. Yeah, well, because I do like I anchor on a lot of sector rotation, index rotation. Like I feel like one of the edges we have as swing traders is hitting rotation models. And so I do a tremendous amount of top-down analysts. Like that's one of my specialties is top-down. That's what I do. And so like I feel like if we can hit a rotation theme and beautiful things. So I do a lot of like index to sector analysis. I like to go where the money's flowing. That's good. A good question though. That is a beautiful car. Top down, baby. That's right. Let that wind touch the hair. Now I don't have that type of hair to have that wind like blowing in there. I'm gonna have to wear a wig. I'm gonna go get a Trump wig, take the top down. We're gonna have some fun. Top down, and all you see is your head out, nectarines. Oh, that's funny. I'm gonna take a picture. I'm gonna go get the wig today. I'm gonna have to cut a hole out of my truck though. Worth it. All right, guys. Well, I had a tremendous amount of fun today. Thank you so much for coming out and hanging out in the BluSky Lab. Tell somebody about it for next week. And with that said, I hope everybody has a wonderful rest of your day. And let me know if you guys need anything. Thanks, team.